Hello. This lecture is about understanding market liquidity. So what I'm about to share with you is the key things that you need to know in order for you to fully understand liquidity and how to potentially trade it and spot it in the market. So liquidity refers to the orders that rest above or below swing points in the form of stop losses and price delivery areas such as order blocks, fair value gaps, and all that, which are used for mitigation of price and imbalances such as a fair value gap or an order block for a continuation move to external range liquidity.
External range liquidity, ERL, liquidity that is found above or below swing points of a range, such as relatively equal highs or lows, clean high or low, and trendline liquidity, which is complete mitigation. What I mean by complete mitigation is that you can see this order block was traded back into, and you can see that the market created some sort of improper structure, or rather each previous candle was traded into. Like you can see this order block up close candle closed above, and the next bearish candle traded back into this order block. That forms a clean level where you can draw a trend line. Even here you can see this wick got traded back into by this wick. Even the next candle traded back into the previous wick. Same applies to this candle. The wick was traded back into by the following candle, where we can now draw a clean trend line over that. Even here you can see that this order block was traded back into twice, actually, here and here. That forms a level of complete mitigation where we can draw a clean trend line, which is essentially a draw on liquidity. So liquidity is essentially what moves the market. So for instance, if a bank wants to buy, let's say, 4 billion euros inside of this order block, they wouldn't execute the entire 4 billion at once, because that would cause the markets to spike, just like the way we see a FOMC or NFP, those kind of reactions. But what they do is they open a position for, let's say, a 1 billion euro at this point, and this will cause the markets to move up by into our PD array, which is our fair value gap, a draw on liquidity, where they offload some of those initially executed buy position from that 1 billion euro position. Then they execute a sell position to drive price lower to a discount array, in this example a fair value gap, where they execute more buy positions out of that 4 billion initial plan, which will drive price to our determined draw on liquidity, or rather their determined draw on liquidity, because they are essentially the market makers. So at each bullish PD array in this example, the market makers will buy, or rather the banks will execute more buy positions, which will fulfill that initial order of 4 billion euros, targeting our external range liquidity. So a little recap on what I've just said. At each bullish PD array in a bullish market, the market makers, or rather the banks, will execute more buy positions out of the initial 4 billion position plan, which will move price to their determined draw on liquidity. So even here at this order block, the market makers opened more buy positions towards our draw on liquidity. You can even see how this was an aggressive move up, taking out our external range liquidity.
Second type of liquidity, internal range liquidity, IRL. liquidity that is found inside of a range such as PDRAs, which can be in the form of order blocks or a fair value gap, and it is used to mitigate price levels and market imbalance. Like I said in the previous slide, the banks use these levels, internal range liquidity, to reprice the market or mitigate price levels where they push price to a certain level where they offload or book more orders into the market, causing the markets to move lower. So in order for the markets to sell here, I'll give an example of the same 4 billion euros. For the banks to sell 4 billion euros from here, there must be an exact amount that is equivalent to the 4 billion euros that is in a buy position in order for them to execute this 4 billion sell position. Do you understand? Let me repeat that. So in order for the banks to sell 4 billion euros at this internal range liquidity, there must be an opposing buy order of 7 billion euros. This is what causes the markets to pair the orders at this internal range liquidity in order for price to mitigate this imbalance and continue with the move, targeting the range low, which is our external range liquidity. This continuous cycle creates the highs and the lows in the market where we sell from and buy from respectively. So what I'm trying to say is that the market essentially moves from external range liquidity to internal range liquidity, then from internal range liquidity to external range liquidity. It's just a continuous cycle. When the market takes out external range liquidity, it will be drawn to a level of internal range liquidity, such as a fair value gap or an order block. Drawn liquidity is simply the next PDRA, such as a fair value gap or a pool of liquidity, example, equal highs or equal lows you are targeting. Both internal range and external range liquidity can be used as your draw on liquidity. So the first thing you have to do when you're analyzing the market is that you have to take note of your trend and if you're at a key level or not. That's when you get to determine your next draw on liquidity. A key level can be either an internal range liquidity such as a PDRA or a fair value gap can act as a key level, or if you have hit a support and resistance level, that can also be your key level. So once you establish that, you take note of where the market will potentially draw to, and that is your internal or external range liquidity. Like in this example, we had hit an internal range liquidity, which was a fair value gap, that was our key level. We would anticipate our draw on liquidity to be this high or this major range high to be our draw on liquidity according to our trend in this example. On the next slide, I'm going to show you a breakdown of a trade that I actually took and posted on my Facebook page on USD JPY. From the weekly chart, I'm going to show you how I applied the exact same concepts on liquidity that I just walked you through in relation to how I actually came up with a buy setup on USD JPY. So the first thing that I'd looked for is where we were currently at in the market. As you can see, we were at a weekly rejection block and the markets took external range liquidity, the key level. So the next thing that I looked at is the next draw on liquidity. Since we're coming from a weekly rejection block, the next draw on liquidity that I paid attention to is this weekly fair value gap. On the 4-hour chart, I paid attention to our weekly range, which was from this low to this high and this newly created low, which reacted off of the weekly rejection block. So as you can see, from this low to this newly created low and this high, the market took out external range liquidity. So my focus quickly shifted to our current trading range, which was from this low to this high. Like I said previously, the market moves from internal range liquidity to external range liquidity and vice versa. So after noticing that the market had taken out external range liquidity, I looked at the newly created range, which is this low and this high, and looked for a potential draw on liquidity back into the range, which was for our fair value gap. So like I said, the next thing that you have to take note of is your external range liquidity. Remember, from internal range to external range liquidity. So our draw on liquidity mainly was this weekly fair value gap. So after noticing that there was an internal range liquidity here, I knew with confidence that the market will be drawn to this internal range liquidity and move towards our weekly drawn liquidity, which was this fair value gap. So looking at this exact same chart, I can show you a few examples based on the same liquidity concept that I have just shown you. Like here, for example, we knew that we had a weekly rejection block here, which was our key draw on liquidity. So after noticing that the market had broken this low and created our new range, so it took out external range liquidity here. So the next thing that you're supposed to pay attention to or look for is your next draw on liquidity, which was our internal range liquidity fair value gap. So looking at another example explaining the same concept, you can see that from here we had relatively equal lows. This was our draw on liquidity mainly, and you notice that the market had taken out external range liquidity from this high to this low. The next thing you're supposed to look for after noticing this is where is our draw on liquidity, internal draw on liquidity, which was this fair value gap and our old block. So as you can see, the market, after reaching our fair value gap, it made a liquidity grab, which is a sign of strength because the candles closed below the high of this candle. They closed below. That's a sign that the market will reverse. So if a candle sweeps a high, then the candle that swept the high closes below this high, then that's a sign that the market will potentially be drawn to your next draw on liquidity, which was our newly created low and our relatively equal lows. So using the same concept, external range liquidity to internal range liquidity to external range liquidity, which was our lows. So even on this very first example that I showed you, you can see that the market moved from internal range liquidity to external range liquidity and hitting a weekly key level. Then it was drawn towards our external range liquidity, which was our newly created low. Another thing that I'd like you to actually go out in your charts and investigate is that see how this low was displaced through by this big bearish candle and left a fair value gap. You can use this as your draw on liquidity because this low was displaced through, and therefore it has created an imbalance in the market. This can be used as your draw on liquidity. You can see how the market respected this level. You can see how the market was drawn to this level and it never closed above this low. I'm not saying that it always closed below However, the market respects a law that has been displaced through, and it can be used as a draw on liquidity for price to mitigate. And most of my students know this and they utilize this in their trading day in, day out. Some applies with the liquidity concept. It actually goes way deeper than this. So this is just a shallow breakdown of how I use the liquidity concept to look for trades every day in the market on literally any pair or any instrument that is tradable. This can be used on synthetics, indices, cryptocurrencies, everything, so long as you take note of the following, which is the trend. Like, what trend are we in? If we're in a downtrend or if we're in an uptrend. The next key thing you have to take note of is that where are we at the key level or not. This will guide you into knowing if the market still has room for a continuation or not. Like I outlined in this very same example, we were at a weekly key level, so we knew that the market would potentially form a reversal towards the next draw on liquidity, which is the next key thing you should take note of. Your draw on liquidity. Where is your next draw on liquidity after market has hit a key level? So that will be your target for the trades that you will take. That's where you'll be looking for the markets to trade to. And the last thing you have to take note of is your current trading range. Like I outlined in the first example, after the markets took external range liquidity, my attention shifted to our current trading range, where I looked for internal range liquidity, where I'll take a buy to target external range liquidity. And I advise you go into the markets and you investigate the things that I've just given out to you and see how the market really works and how it moves and what causes the markets to move in the way that it does, creating these highs and lows, and how you can potentially take advantage of these movements in relation to liquidity, which is external and internal range liquidity, as well as your draw on liquidity for your trade targets.